Okay, let's unpack this. Imagine a name just completely synonymous with power on Wall Street. Prestige, relentless ambition.
Yeah, a real titan.
We're talking about Lehman Brothers. I mean, this institution stood tall for over a century and a half. Its
Yeah.
roots. A small dry goods store in Montgomery, Alabama, believe it or not.
Founded way back in 1844 by three immigrant brothers. Amazing history.
Absolutely. They weathered wars, depressions, market crashes. Seemed almost indestructible.
Until they weren't.
Until September 15th, 2008. That date. It's not just a footnote, is it?
No, not at all. It marks one of the most dramatic, just cataclysmic collapses in global business history, period.
So today we're doing a deep dive. We're going into the machinery of Lehman's downfall, using our sources to really get a handle on its huge lingering impact. On the financial system, yes, but ultimately on your world, too.
And what's really fascinating when you look back at Lehman, it's not just one single mistake. It's a story with layers.
Right.
It wasn't just a business messing up. It felt almost theatrical, this unraveling.
How so?
Well, it just laid bare that really dangerous tightrope walk between ambition and, well, caution, between chasing profits and being prudent.
Greed versus sense, maybe.
You could say that.
Yeah.
Lehman's end was this crucible moment. It didn't just shuffle the financial world around. It fundamentally changed how we think about risk, regulation, and how, interconnected everything is globally.
So understanding it isn't just looking back.
Exactly. It's vital for understanding the vulnerabilities that are still out there, still evolving in finance today.
And Lehman at its peak. Wow, our sources paint this picture of just immense power.
Absolutely.
We're talking the fourth largest investment bank in the U.S., managing assets north of $600 billion. That's staggering.
It really is. And their reach wasn't just Wall Street.
No, it was global. Continents. They were deep into everything. Bond trading, underwriting big corporate deals, mortgage origination, complex asset management.
They seemed diversified, powerful.
Invincible, almost.
Yeah.
But here's where it gets really interesting and kind of chilling.
Yeah.
Even with all that success, all that apparent stability, the seeds of its collapse were already being sown, aggressively, often right under the banner of growth.
That's exactly right. And those seeds, they were planted deep in strategies that just got more and more reckless over time.
Okay, so what are we talking about specifically?
Our sources are pretty emphatic. Lehman's huge, ultimately uncontrolled dive into the subprime mortgage market. That was the main thing.
Subprime, the risky stuff.
The very risky stuff. This wasn't just dipping a toe in. It was a full-on cannonball into pursuing profits that just flew way past any sensible definition of prudence.
So they were originating these loans, buying them.
Both. Heavily invested in originating and snapping up these high-yield but high-risk mortgages. And then, the really crucial part, they packaged them.
Ah, the infamous MBS and CDOs.
Precisely. Mortgage-backed securities, MBS, and collateralized debt obligation CDOs. You've probably heard those terms thrown around.
Yeah, definitely. But maybe break it down quickly for us. How are these things supposed to work, and why did they end up being so dangerous for Lehman?
Sure. So think of it like this. An MBS, initially, was pretty straightforward. You bundle a bunch of individual home mortgages together.
Okay.
The logic was diversification, right? If a few homeowners default, most won't, so the overall bond remains pretty stable. It seems reasonable.
Mm-hmm.
But then came the CDOs. These were like layers built on top of the MBS.
More complex.
Much more complex. You take the riskiest slices, the lowest rated bits, often called tranches, from lots of different MBS bundles.
Okay.
And then you'd repackage those risky bits into a new security, the CDO. It was clever financial engineering, or so it seemed.
Alchemy, almost.
You could call it that. It promised to slice and dice the risk even further. Rating agencies, controversially, often gave surprisingly high ratings to these new, super complex products.
But the reality was different.
The reality was it wasn't diversifying risk. It was concentrating systemic risk. When the housing market finally turned south.
Which it inevitably did.
Right. Those underlying mortgages, especially the subprime ones, started defaulting like crazy. So the diversified MBS bundles, and particularly those repackaged CDOs,
Became toxic waste.
pretty much.
Yeah.
Toxic almost overnight. It became incredibly hard, almost impossible, to figure out what they were actually worth or how big the losses might be. It was, well, a house of cards.
So it wasn't just the sheer number of mortgages they held, but this really intricate, almost opaque way they were bundled and rebundled, hiding the real danger.
Precisely.
Yes.
And the whole thing was turbocharged,
Yeah.
easy credit was everywhere, and everyone just assumed the housing market would boom forever.
That assumption cost dearly.
Immensely. And inside Lehman, the pressure for returns was intense. Our sources talk about this really competitive, almost cutthroat culture.
And the CEO, Richard Fuld, the gorilla.
Yeah, nicknamed the gorilla for his aggressive style. He really embodied that drive. There's this quote from him. Looking back, he said, "When the crisis hit us, the heavens had been stormed in a mortifying manner."
The heavens had been stormed.
That-
Wow.
It paints a picture, doesn't it?
Yeah.
Intense pressure, maybe some denial, maybe just being completely overwhelmed when the wave finally crashed.
It suggests a sort of blindness, perhaps? Or maybe just not wanting to see the dangers piling up.
Could be. Whatever it was, by 2007, those cracks Fold mentioned, they weren't just cracks anymore. They were becoming chasms.
The housing bubble starts to strain, defaults mounting.
Exactly. And that market for those complex mortgage securities Lehman had bet the farm on, it just faltered, seized up
Which showed just how fragile the whole thing was.
instantly. And the impact was real, tangible. Huge losses started hitting the books. Specifically, that staggering $3.9 billion loss in just the third quarter of 2008.
That wasn't just a bad quarter.
No way. That was the klaxon horn sounding. A terrifying sign of the catastrophe that was unfolding fast.
So what was the mood like inside Lehman then? Must have been panic stations.
Oh, absolutely. Our sources describe it as frantic, desperate scrambling. Once those losses hit and became public knowledge, confidence just evaporated.
Investors, counterparties,
Yeah.
everyone running for the exits.
Pretty much. The firm was bleeding cash. So they launched this desperate search for a lifeline, right? A white knight to ride in and save the day.
Which involved frantic talks.
Round-the-clock negotiations,
Yeah.
high-stakes stuff. They talked seriously with the Korean Development Bank, which was state-backed,
Right, I remember that.
and also, very famously, with Barclays, the big British bank.
It sounds so dramatic, these last-ditch efforts. But they all failed. Why couldn't they seal a deal? What went wrong?
That's a really crucial point. And it shows how Lehman's situation was kind of unique. With the Korean Development Bank, well, there was interest initially, but the deal fell apart. Political opposition back in South Korea, apparently. And just real difficulty putting a price tag on Lehman's assets, which were looking more toxic by the minute,
Too complex, too risky.
and just a reluctance to take on such a huge, unknown liability. Then came Barclays.
They seem like a real possibility.
They were genuinely interested.
Yeah.
But then the British regulator, the Financial Services Authority, basically put the brakes on. They insisted that the UK government would have to guarantee Lehman's bad assets if Barclays bought them. They were terrified of importing that toxicity into the UK banking system.
And the UK government said.
No deal. They were already wary after the Bear Stearns situation in the US. They wouldn't offer that guarantee. So Barclays had to walk away.
Wow. So it wasn't just a simple no. It was this tangled web, national interests, regulatory fear, just sheer terror of the unknown quantity of risk.
Exactly. It doomed those rescue efforts. And that leads us to the really pivotal and, highly controversial decision that sealed Lehman's fate, made it different.
Different from others caught in the storm.
Precisely. You have to remember the context. Just months earlier, the U.S. government had stepped in. They orchestrated a rescue for Bear Stearns, another big investment bank on the ropes.
And they later bailed out AIG, the insurance giant, massively.
Right. But for Lehman, nothing. No government rescue. The plug was pulled.
Who made that call? It must have been intense.
The key players were Treasury Secretary Hank Paulson, Fed Chairman Ben Bernanke, and the New York Fed President Timothy Geithner.
And their reasoning. Why help Bear Stearns and AIG but let Lehman go under? That's the big question.
It is. And our sources dig into this. Their stated reasoning was heavily focused on belief in market discipline and wanting to reduce moral hazard.
Okay, moral hazard, explain that briefly.
It's the idea that if you constantly bail out institutions when they get into trouble.
You just encourage them to take even bigger risks next time because they know they'll get rescued.
Exactly. They wanted to send a message. Take responsibility for your risks. But was it that simple? Was everyone agreed on that inside the room?
Good question. Were there people arguing for intervention? Saying, wait, letting Lehman fail will be even worse?
Oh, absolutely. Our sources make it clear there was no easy consensus. The debates were described as incredibly intense, heated, agonizing even.
So Paulson, Bernanke, Geithner pushed the moral hazard line?
Yes, but there were definitely voices, both in the wider financial world and probably within government, arguing fiercely against letting Lehman fail.
Warning of panic.
Warning of unprecedented panic. They argued the systemic risk, the risk to the entire financial system from Lehman collapsing, far outweighed the moral hazard concerns.
But the decision makers didn't buy it, or felt they couldn't act.
They ultimately made a judgment call. They felt Lehman didn't have enough good collateral for a government loan, and they saw its web of derivatives as just too tangled, too complex to unwind safely, even with government help.
They felt Bear Stearns was different.
They saw Bear Stearns as a one-off, yes.
Yeah.
So the decision was made. Let Lehman file for bankruptcy. And that decision, well, you called it seismic. It absolutely was. The shockwaves went everywhere.
Seismic is the perfect word. And the fallout was instant. Terrifying. Lehman going under wasn't just bad news for its employees or stockholders.
Not even close.
It triggered this chain reaction. Fear just gripped global markets. Instantly, stock markets around the world just tanked. Trillions wiped out.
And worse, maybe, was the credit markets.
Exactly. The plumbing of the financial system, it just froze solid. Banks literally stopped lending to each other. They had no idea who might be next, who was exposed.
The commercial paper market seized up that's crucial for businesses' day-to-day cash. Money market funds, supposedly ultra-safe, broke the buck, caused huge runs.
Right, people pulling their money out in panic, and banks everywhere were scrambling, weren't they? Trying to figure out their exposure to Lehman, to those toxic assets.
Complete chaos and uncertainty. And if you remember that time, late 2008, early 2009, it wasn't just a Wall Street story.
No, it hit Main Street hard. It poured fuel on the fire of what became the Great Recession, mass job losses, homes foreclosed on a scale we hadn't seen in generations.
And a deep, deep questioning of the whole system. How could this happen? Where were the regulators? It was a scary, uncertain time for absolutely everyone.
So if we step back and try to connect this to the bigger picture, what are the main lessons we learned or should have learned from Lehman?
Well, our sources point to 3 core lessons, I think. They're pretty stark, and they still echo today. The first, and maybe the most obvious, is about the danger of too much leverage.
Borrowing too much money to make bets.
Exactly. And coupling that leverage with really risky, complex financial instruments. Lehman showed leverage isn't just a way to boost returns. It's a massive risk multiplier.
Turns small cracks into giant holes.
Instantly.
Yeah.
Especially when it's tied up in opaque things like CDOs that nobody fully understands. It hammered home the need for, well, serious risk management and much tougher, smarter regulation. Not just for one firm, but across the whole system.
So lesson 1. Beware excessive leverage and complexity. It can hide catastrophic risk. What's number 2?
Number 2 really underscores something maybe less tangible, but just as important. Market confidence.
Trust.
Trust, absolutely. Lehman proved that more than fancy algorithms or AAA ratings, the real currency in finance is trust, once that evaporates.
It doesn't matter how good the assets supposedly are.
Exactly. Once people lost faith in Lehman's solvency, and then, crucially, in the stability of the whole system, even decent assets became untouchable. Trust is the bedrock, right? But when it goes, it acts like an accelerant for the crisis.
The speed was shocking.
Unprecedented.
Yeah.
It created this devastating feedback loop. Lack of trust leads to selling, which drives prices down, which destroys more trust. Vicious cycle.
So trust is fragile and absolutely critical. And the third lesson?
The third lesson really highlights that incredibly tough balancing act policymakers face. It's this constant tension between dealing with moral hazard.
Not encouraging bad behavior with bailouts.
Right, and the need to maintain systemic stability to prevent the entire house from burning down. Lehman became the ultimate test case for this dilemma.
The decision to let it fail was about market discipline.
That was the rationale. But it unleashed a level of instability that arguably cost far more in the long run.
Yeah.
There's just no easy answer, is there?
No clear playbook.
Not at all. Central bankers, finance ministers, they still wrestle with it today. When do you step in? When do you hold back? How do you weigh those risks when the entire global economy could be hanging in the balance? It's a profound challenge.
So putting it all together, Lehman Brothers, it's clearly more than just some old business failure story.
Much more.
It really stands as this huge cautionary tale, doesn't it? But also a critical turning point in financial history.
Definitely both.
Its collapse wasn't just about greed and bad risk-taking colliding, though it was certainly that. It was also, weirdly, a catalyst. It forced change.
A painful catalyst, but yes, It directly led to major shifts in financial regulation. The big one in the U.S. was the Dodd-Frank Act.
Yeah, a huge piece of legislation.
Yeah, aimed at making the system safer.
Mm-hmm.
More oversight, higher capital requirements for banks, ways to unwind failing firms, hopefully more smoothly than Lehman.
Yeah.
It really did change the rules of the game.
So the system is safer now, or just different?
That's the ongoing debate, isn't it? The core message, I think, is that financial systems, yeah, they're resilient, they can take huge hits, but they're also always inherently full of vulnerabilities.
And those vulnerabilities demand constant watchfulness.
Constant, relentless vigilance. Lehman is the ultimate reminder that chasing innovation and profit, if it's not checked by real prudence, by effective regulation, it can end in disaster.
So a final thought for our listeners to chew on.
Well, as we look back at Lehman's dramatic fall,
Oh.
maybe consider this. What new vulnerabilities might be quietly building right now in today's financial landscape?
Where should we be looking?
Maybe in areas like the massive growth of private debt or increasingly complex derivatives, maybe even in new digital assets and crypto, these new frontiers.
Yeah.
Well, they might just be demanding the same kind of vigilance, the same critical look that we learned the hard way we needed from Lehman's collapse.